Hello, everyone. SIP is one of the most popular ways to invest in mutual funds in India. As of March 2021, there were over 2 crore SIP accounts with an average monthly investment of around 7,500 rupees. And most of these SIP accounts are created by salaried individuals because SIP is the easiest way to save and invest for long-term goals like retirement planning, buying a house, children's education, etc. But despite so many people investing through SIP, most investors do not know what smart investing actually means. So in this video, we'll discuss how SIP works, why SIP doesn't always work as expected, and most importantly, what you can do instead of just investing blindly through SIP. Before we begin, if you're new here, please hit the subscribe button to stay updated. Let's get started. First, we'll understand what is SIP. Now, SIP stands for Systematic Investment Plan, and it's simply a method of investing a fixed amount of money at regular intervals in a mutual fund. When you set up an SIP, you decide the amount you want to invest every month, the fund you want to invest in, and the day on which you want to invest. Then, every month on that particular day, a fixed sum of money is automatically deducted from your bank account and invested in that mutual fund. By doing this, you become a shareholder in that mutual fund. Now, suppose you invest 1,000 rupees every month in a tax-saving fund during the financial year, then you can save taxes as well. Now, let's try and understand how SIP works using an example. Suppose you invest 500 rupees every month in a hypothetical aggressive hybrid fund with a benchmark return of 8% per annum. Now, see the price movement of the fund. Assume that the unit value of the fund is 12 rupees at the beginning of the month. Then, after a month, the unit value becomes 11 rupees, and after 2 months, it becomes 13 rupees, 50 paisa. So now, let's calculate the number of units you will receive every month. In the first month, you invested 500 rupees at 12 rupees per unit, so you bought 41 units. In the second month, you again invested 500 rupees, but the unit value dropped to 11 rupees, so now you bought 45 units. Likewise, in the third month, when you invested 500 rupees, the unit value was 13 rupees 50 paisa, so you received 36 units. In total, you received 122 units after investing 1,500 rupees. Now, if you hold all these units for a very long time, you can earn an 8% annualized return, which is the benchmark return of the fund. Now, let's try and understand the benefits of SIP. Firstly, SIP allows you to invest in the markets on different days, thereby reducing your exposure to market risks. Secondly, SIP enables rupee cost averaging, which means you will buy more units when the market is down and fewer units when the market is high, thereby reducing the impact of market volatility on your investment. Thirdly, since SIP encourages discipline and consistency, it makes the investment journey easier, especially for salaried individuals. Now let's understand why SIP doesn't work. Now, there is a myth in the market that SIP guarantees good returns and completely eliminates the risk of loss. Well, this is not true. In fact, if the market stays flat or declines for a long period, your returns could be low or negative. For example, between January 2009 and March 2017, the Nifty 50 index returned only 3.8%, which is lower than the inflation rate. So if someone had invested through SIP during this period, they would have suffered a real loss. The second reason why SIP might not work is wrong fund selection. You see, if you invest in a poorly performing fund or a fund that is not suitable for your needs, then SIP will not serve its purpose. For example, if you are a conservative investor, you should avoid investing in very aggressive hybrid funds through SIP. Similarly, if you need to save taxes, you should not invest in a very aggressive hybrid fund through SIP. And finally, if you don't have a long-time horizon, investing through SIP is a bad idea. That's because SIPs are meant for long-term goals like retirement planning, buying a house, children's education, etc. So if you need the money within a few years, withdrawing it early would mean losing out on the benefit of compounding. Now let's understand what smart investors do instead of investing in SIP blindly. Number 1, set clear financial goals. See, before starting an SIP, you must determine your financial goals and the amount required to achieve them. Are you investing for retirement planning, buying a house, children's education, etc.? Once you have defined your goal, it will be easier to choose the right fund. Number 2, choose funds based on 3 parameters: your risk profile, time horizon, and current market conditions. See, if you can say you have a long time horizon and a high-risk appetite, you can consider investing in a tax-saving fund or an international fund through SIP. On the other hand, if you have a short time horizon and a low-risk appetite, invest in a liquid fund or a short-term debt fund through SIP. Number 3, review and adjust your SIP at least once a year. Your income, expenses, savings, and goals will change over time, so it makes sense to review your SIP at least once a year and make necessary adjustments. Number 4, consider investing through a step-up SIP. In a step-up SIP, you agree to increase your contribution every year or every few years. This can help you buy more units when the market is down and fewer units when the market is high. In addition, it also inculcates the habit of investing more as your income grows. Number 5, combine SIP with lump sum investments. When the market falls significantly, consider investing a lump sum amount along with your next SIP installment. This can help you buy more units at a discounted price. Now let's understand some important financial terms. The first term is NAV, which stands for Net Asset Value. In simple terms, NAV is the value of one unit of a mutual fund. For example, if the net asset value of a mutual fund is 12 rupees, it means that one unit of that fund is worth 12 rupees. Now, the second term is rupee cost averaging. We have already explained this concept, so feel free to skip to the next term. The third term is expense ratio. Expense ratio is the fee charged by the fund manager for managing the mutual fund. It is expressed as a percentage of the total assets under management. A lower expense ratio is better because it increases your returns. The fourth term is growth versus dividend plan. In a growth plan, all the profits earned by the fund are reinvested back into the fund. On the other hand, in a dividend plan, a portion of the profits is distributed to the investors. Both options have their pros and cons, so you should discuss them with your financial advisor. The fifth term is large cap, mid cap, small cap funds. Large cap funds invest in large companies, mid cap funds invest in mid-sized companies, and small cap funds invest in small companies. Large companies tend to be more stable, while small companies tend to be more volatile, but have the potential for higher growth. Now let's quickly look at some beginner tips related to SIP. First, start small. There is no need to invest a lot of money every month. Even 500 rupees is fine. The important thing is to start investing as soon as possible. Second, use SIP calculators. An SIP calculator will tell you how much you can expect to earn by investing a certain amount every month. Third, avoid emotional decisions. Don't invest more when the market is high, and don't panic and stop investing when the market is low. Stick to your investment plan. Fourth, be patient. SIP rewards long-term investors. So don't get discouraged if you don't see results immediately. To know more about mutual funds, click on that banner. Also, check out these useful videos related to SIP. Thank you for watching. If you found this video useful, hit the like button and share it with your friends. Also, if you haven't subscribed yet, please hit the subscribe button to stay updated.